I wanted to bring on an expert like Dan. He comes from our world in sales. So without further ado, Dan, do you want to introduce yourself and maybe set the stage for what we're going to learn from you today?
Yeah, thank you, Brandon, and good to be with you all. Really appreciate you bringing me in. I, like many of you, have followed Brandon's content for a while, and I had just reached out to him because I frankly liked what he was talking about, a lot of different levels. So we've gotten to know each other, as he mentioned, over the last few months, and I'm really excited to chat a little bit with the community today. So, yeah, by way of introduction, I'm Dan Pascone. Today, I run a comprehensive wealth management firm called Tailored Wealth. I'll talk a little bit about who we serve and what we do later on. But as Brandon mentioned, I do come from a sales background. So I started as a sales individual contributor. Started at a big Fortune 100 company, uh, and then had several different seats in sales leadership. Went to kind of a scale up organization, and while I was there, I got the entrepreneurial bug, and I started this firm while I was still in a corporate role. And so I was in a sales leadership capacity, and I started this business. And then I ultimately exited it and went into this full time several years ago. So I can talk, as we go about a little bit of my own transition going from the corporate world into business ownership. And now we've helped a number of folks or are helping a number of folks to do that. So when I built this firm, I really wanted to serve people like me, and people that face some of the same challenges that I faced when I was in a corporate role. And so I kind of built the business around helping, revenue professionals, people with variable compensation, complex compensation, because I knew that well. I heard somebody joking earlier about signing their commission, their comp plan like midway through the year. Like, the amount of stories I've heard around that are endless, and I could chat about that for days. But I really wanted to serve people like this. And then along the way, this concept didn't really resonate with me when I was doing it myself, but this concept of Brandon calls it fine, which I love that framework. In fact, I've stolen it and put it into some of my content. So I owe Brandon, I owe Brandon some kickbacks on that, some royalties over time, because I've stolen that framework. But I started calling it hybrid retirement. And the reason why I started talking about this is frankly not because I had some epiphany or because like I came up with the concept myself. It was just that all the new clients that I was chatting with, like almost all of them wanted this same thing. Right. And so I was like, well, there has to be something here. Right. So I built the business to serve revenue professionals. And then along the way, we got like even more specific about our niche. And it really became focused around helping corporate professionals that ultimately want to transition into the next phase of their career, whatever that looks like. Right. So we can chat a little bit about, some different things that I've seen people do or that I'm seeing people plan for today, because, the opportunities are really endless. I think, especially in today's work environment, given a rise in remote work, B, fractional consulting type gigs becoming a lot more popular, content, business ownership being a lot more attainable. So there's a lot of factors that are making this sort of, go from corporate to doing some form of your own thing phase a lot more attainable. So what I've learned after helping another number of folks to ultimately accomplish this, or working with them to accomplish this. I play a small role in that, but there's really two different factors that need to come together. You need to have the financial plan and the financial framework in check. And then you need to have the career plan and like, what do you actually want to do with the next phase in check? And I'm a big believer that those two things need to be married very nicely together. Okay. So I love collaborating with, working with, and learning from people like Brandon who help with that career piece. And then, we're typically helping our folks, with the financial planning piece. Okay. So what I thought I would do today is share a few thoughts around what I've seen work well with that transition and some of the financial concepts that I would be thinking about if I were to go do that again. I chatted with Brandon yesterday. And I told him I didn't do it the right way myself. So there's, some of this is my own personal lessons learned. And then a lot of it is frankly things that I've learned for a number of years now running this business and working with people that are in a similar position to what Brandon described earlier. So if it works for you all, I'm happy to take questions along the way. So I know we've got some people that are on camera, some people that are not. Feel free to just either use the Zoom raise hand or come off and just, stop me if you want me to elaborate on something or you have a specific question if that works for you all.
Sounds
Cool.
great, Dan.
All right, cool. So let's get into it. I want to talk a little bit about this concept of just, how do you navigate from corporate world into the next phase? And I'm going to leave whatever that next phase is, fairly broad here for the purpose of today's discussion, because I think there's a number of different things that you can do. But what we've done is we've built a framework to help people to get to that next phase from a financial perspective. Okay. And I'm going to give you kind of look under the hood, albeit I'll give you the disclosure. I'm giving you a high level summary. There's a lot of work that goes into this. And I'm not going to give, or I'm not able to, given our fiduciary capacity, able to give specific advice to any of you. But I'm going to give you contextual guidance based on what I've seen from other people in similar positions. Okay. So let's talk a little bit about like what that structure looks. The first thing that I always recommend people do, and I think it sounds like this community really has a leg up in this first step, certainly compared to most of the folks that I start working with, is to define what you want the next phase of your career and your life to look like. Frankly, like that's usually the thing that is the biggest challenge for new folks that we're working with at our firm. And we have a whole series of questions and like a just a thought provoking process that we take people through to help them to kind of identify that. But taking some time to really define that and think about it is the most important first step, because then you can kind of build a framework around that. And by the way, I should have mentioned this up front. Everything that I'm going to mention today, I have content. Okay. So I'm happy to share at the end. In fact, I'll even throw it in the chat. You can check out our website. I'll put it in here now. We have free content on literally every topic, whether you like written content or you like video content. I usually have something on every single one of these topics on both. And just click the free content section. And then if you just want to, if you have any specific questions that you want to reach out to me on, I'll throw my LinkedIn profile in there as well. Okay, so let's get into it. You define the next phase of your career and the next phase of your life. Okay. And listen, what we're typically doing is we're typically saying, you don't have to be super specific. You might have a couple different scenarios. And I call that scenario analysis, right? So you might say, my goal is to exit the corporate world in 3 years. And I'm making this up. I'm going to make up a lot of random scenarios today. And if you guys want to throw at me, ones that you want me to just tweak up and talk about those, I'm happy to do that. But let's say you want to leave the corporate world in 3 years and you think that, well, there's going to be a dip in income for a 2 to 5 year period until you build up some form of income that grows over time. Okay. That might be one scenario. Another scenario might be I am going to take a 2 year sabbatical. I'm going to go look for and invest in a business that then in year 3, I could expect to be cash flowing. Okay. And there are a myriad of different scenarios that we can model out, right? But the idea is to define what those potential options could look like so that you can see what the financial plan for each might be. Okay. And that usually, in my experiences, allows people to start to really visualize it. You can kind of start to feel it. And then through a lot of the work that you're doing with Brandon or that you're doing on your own to help figure out that next career phase, you can go work on making those things happen. Does that make sense? Any questions on that sort of framework of like defining what the next phase looks like?
Are there any specific areas? I mean, again, these are some one-on-one conversations I have with some of the members here, kind of like defining what that is. But have you noticed that there's anything specifically that a lot of folks are gravitating towards, or is it just sort of like wide open green space right now? Is it like like you brought up an interesting topic, which seems to be sort of a hot topic right now with like the Cody Sanchez's of the world. Like, go buy a boring business, right, and cash flow it. Others might want to like monetize their specific knowledge that they've accumulated throughout their sales career, and that's kind of where maybe a lot of the folks I work with are leaning. Is there anywhere like you're finding, wow, it's just wide open space? It's you just have to take the time to find that for you personally.
I think it's definitely specific to you personally, but the two you mentioned are very hot right now. Okay.
Yeah.
Right. So whether it be monetizing your knowledge base, and I love what you talk about, Brandon, around, sort of like what's coming in the world of the AI and being able to like put that in your favor versus having it work against you, which a lot of times is the case if you're in a corporate function. Those two that you mentioned are probably the two most predominant ones. I see a lot of people looking to consult, do fractional work, or create some form of content or collateral that they can monetize. That's a big one. The Cody Sanchez model is becoming popular. I don't mind telling you, my wife's in a corporate role today. We're looking to do that for her.
Mm.
She wants to own and run boring businesses, right? And we like it from our family financial plan perspective because it's very, very different than my business and has a very different risk profile, different return profile. Just it's diversified if nothing else, right? So I think both are great concepts. I've seen people invest in franchises. I've seen people, go in on partnerships. Seen people create just like small little consultancies that ultimately become big. There's the world is kind of endless there.
Yeah.
And listen, you're never going to really know until you get into it
Mhm.
what that could potentially cash flow, right?
Yep.
So like that's going to be a segue into my next piece. But if you have an idea for what you want the time frame to look like, you can start to back into the financial plan, right? So what I always ask people to do, and what we do for folks, but you could do it yourself, is once you understand kind of like what that next phase could look like, or at least a couple different scenarios that you want to consider, then what you need to do is you need to build out your cash flow. Okay. And the cash flow is basically what what's coming in and what's going out, right? When you're in a corporate role, you likely have, I mean, most of the folks that we work with have some form of W-2 salary. They might either have commissions and or variable bonuses, and they may have equity comp, or they have a combination of all of the above, right? So that's your revenue, if you will. And then you've got your expenses, right? And so mapping out what the cash flow looks like both during the corporate career and then conservatively what that may look like post corporate career.
Mm.
What I tell folks all the time is sometimes people feel like they need to replace that paycheck right away. And if they've done a good job of strategically saving, the reality is they don't, right? In fact, I recorded a video on this literally yesterday, and it was one of the topics that we got into. Sometimes, I think, Mike, you were talking about how much you were paying in taxes this year. Sometimes having a down income year is a really, really great planning opportunity and can actually set you up really well for the future, right? So, especially if you're going to get into business ownership, again, you've got to be able to pay your bills. I don't think anyone, at least Brandon and I, we're I don't want to say anti, but we're not necessarily supporting the fire movement, if you will. We're not asking. I never want anyone that I work with I never want to have to tell them they need to adjust their lifestyle at all, right? Thankfully, most of the people that come to us are not in a position where they have to. So you need to pay your bills, but if you've got the proper savings to support it and you structure it properly, there's no reason that you need to wait to 60 or 65 to dip into your savings. Okay. If it's done strategically. And if you have lower income years, those oftentimes are the greatest tax planning opportunities that you will have throughout your career. Okay. So, like if you look at like a typical retirement, right? Of like somebody, let's just call it an early retirement. Let's just say somebody's at like 55. So they're not waiting until 65 to retire, but they're at 55. We talk about the tax code in three different phases. You have your W-2 earning years where you have very little flexibility. Okay. Are there things you can do while you're a W-2 earner? Yes. But most of what you can do is planning for the future from a tax perspective. The higher earning W-2 is the IRS's best friend. Okay. But the minute that you walk out of a corporate role, the entire tax code opens up to you. Even if you've never owned a business, which again, owning the business is going to give you that much more leverage and that much more opportunity and that much more control. But even if you never owned a business, if you retired at 55, you essentially have until you are, whenever you're taking Social Security, which is somewhere usually between 62 and 70, but for a higher earner, we're usually pushing that out till 70. And then 73, you're forced to take income off of your tax deferred accounts, your 401ks, your IRAs. So you have a window there where there's no forced income on you other than any income that's coming in from your investments, right? So those are massive tax planning opportunities. Okay. Now, again, most people aren't saying, I'm just going to not earn anything for a period of 10, 20 years. If you are in that position, you probably did either some great savings or you sold a business or you got an equity event, which, by the way, I thought I was going to get a huge equity event earlier in my career and it fell through. So if you've ever had that happen, I feel your pain. Yeah, yeah, there you go. So let me get back to that. So it's define what you want the future to look like, and then it's cash flow. What cash flow does is cash flow helps us to build tax plan and investment plan. Right? From a tax plan perspective, we're able to figure out timing, right? We're able to figure out how we want to time different investment strategies. From a tax perspective, you have three different conceptual buckets that you can invest in. You can invest in tax deferred assets. That's your 401k and your IRA. You can invest in taxable investments. That's just your after tax brokerage, high yield savings, whatever you're doing after taxes. And then you've got your future tax free, which is predominantly raw, but you can throw HSAs and you can even consider 529s if you're planning for kids' education into that bucket as well. And there are some types of insurance products that fit in there, but they're longer term strategies. Okay, so let's talk about each of those. Okay, what are the benefits and what are the downsides to each of those? The traditional tax deferred bucket, which most of the time when I get connected with someone, they have a good portion of their assets in their 401k and IRA. The upside is you get a tax break on the money the year that you're contributing it. Most folks probably know that. It grows tax deferred. Okay. The downside is you got to pay taxes on it whenever you draw off of it. Okay. So if you have a large chunk of your savings in that bucket, you're going to have a big tax bill waiting for you when you draw off of it. Okay. The Roth or the future tax free is the opposite, right? The money goes in post tax. So you're not getting the tax break now, but you're getting it in the future. Okay. So you don't have to pay taxes on it in the future. The other benefit to the tax free bucket, especially the Roth, the HSA is a little bit different because it's got the triple tax advantage, but you can only use it for medical expense, right? So that's usually helpful to have for a component. But let's focus on the Roth for a second. The Roth does not require minimum distributions, whereas the traditional 401k and IRA do. So the IRS is going to force you to take income off of the traditional IRA. They don't force you to do that off of the Roth component. Okay. And then the last one, which is one that probably doesn't get enough attention for folks that are looking to do some form of early leaving corporate or early retirement or hybrid, fine, whatever you want to call it, is the taxable. It is the bucket that is the least tax friendly, but it comes with the most flexibility. Okay. Comes with the most flexibility in that you really can tap into it and utilize it whenever you'd like to. Okay. Now, it's the one that needs to be most strategically managed because it comes with capital gains. Okay. So you pay capital gains on the growth, right? So you may have heard of the concept of tax loss harvesting. There's a concept out there right now called either custom or direct indexing that's very, very popular. Used to only be available to super high net worth investors, very much available in some form or fashion to most investors today. Okay. A lot of taxable accounts, the common advice from my community over the years was invest in index funds for your taxable accounts, which still makes sense in some form or fashion. But this idea of using tax loss harvesting is usually an even more beneficial tax strategy. Okay. So again, you've got the three different buckets. Now let's break those down a little bit and let's talk about what do you have at your disposal today? Within most corporate 401k plans, you're going to have at least the traditional 401k that you could contribute to. Okay. The limit on that in 2026 is 24,500. If you're over 50, you get a $6,000 catch up. So you get an additional 6 grand, but it has to go into the Roth bucket this year. If you make, forget the number, 200 some odd thousand last year. Okay. So you've got your traditional 401k. I like it, dude. You've got your traditional 401k. A lot of plans offer the Roth 401k. Okay. So just like a Roth IRA, the Roth 401k is the opposite. Money goes in after tax, grows tax free. Later on, you don't pay taxes on it. You leave the company, you likely convert it to a Roth IRA. Okay. The component that a lot of folks don't necessarily know about that more and more plans are offering is a third bucket. The third bucket is just called after tax contributions into the 401k. Okay. So if you don't know this, I always recommend folks ask their company, can I make after tax contributions to the 401k? Not Roth contributions. It's different. After tax contributions. Okay. Why? Because most plans that they allow for after tax contributions allow for what's exactly awesome. This is the Mega Backdoor Roth. Okay. And there's two different concepts. There's a backdoor Roth and a mega backdoor. So I'll explain them both. If you're making after tax contributions to the 401k, more and more companies are allowing you to make that contribution into this third bucket, right? So traditional money here, Roth money here, third contribution goes into this bucket, and then it auto converts to Roth. The auto convert is key because if you leave it sitting in after tax contributions, you've already gotten taxed on the money. But if there's growth on it, you'll be taxed on the growth. But if it auto converts, usually in conjunction with your paycheck, then there's no gain. And then it just grows tax deferred from the Roth bucket. Okay. So that's the mega backdoor Roth concept. So essentially, what you would want to ask your 401k provider or your benefits consultant is, do we offer after tax contributions to 401k? And is there a mechanism to auto convert? There's actually a second way to do it. If you want insight on that, message me on LinkedIn because it's a little bit technical. I don't want to go too in depth into it today. Okay. So those are the three options that you have with your 401k. Okay. Most high earners can't contribute to a Roth IRA because they make too much money. You can contribute to a traditional IRA and either leave it there in the traditional or convert it to a Roth and pay the taxes on it. And that's the backdoor Roth. That's the traditional backdoor Roth, is doing it in the IRA outside of the 401k. The reason why it's called a mega backdoor Roth is because the contribution limits are far greater within the 401k than they are in the IRA. Okay. So you can put a total of 72,000 into your 401k in 2026. Remember, I said earlier, the traditional bucket, including the Roth, take the catch up aside for a second because the catch up would just get added to this. But the traditional and or the Roth only allows up to 24,500. So that's where the mega backdoor gives you a lot more tax advantage growth if your cash flow supports it and if your plan supports it. Okay. So those are a couple of things to think about. And then generally you have to do a calculation if you're going to do the mega backdoor. If you really want to max it out, you have to do a calculation. And the calculation is 24,500 into traditional and or Roth. But let's call it traditional because we want the tax break on it today. Then whatever the company matches, okay. Let's just say, I'm just going to say the company matches 7,500 just for easy math. Okay. That's going to get you to 32,000. Then you would basically have $40,000 of capacity that you could contribute to after tax and then convert into the Roth via the Mega Mac. That all makes sense. Any questions on that? I know that's a little bit technical, but any questions on that?
I once heard somebody say that you should max out your pre-tax up to the match because some companies, Adobe does like, X% of your salary up to a number. And then after that, you should start just maxing out the mega backdoor. Is that?
It's actually a great question. It's actually a pretty nice segue into what I was going to talk about next. So thank you for that question. Each plan is different. There's a couple of things that you got into there that are worth noting. Number one would be, what are the company matching mechanics? Okay. And like the timing perspective around that. Because I have clients that sometimes come to me and they say, I want to do all of my contributions for my 401k in Q1. Right. I might be getting a bonus, or I just want to get it out of the way and then be able to have more money throughout the year, whatever it is. There's some folks, and some companies will just basically say, we're going to match you up to X% of your salary, regardless of when it comes in. Some companies say, we're actually only going to match X percentage per paycheck. So you got to figure out what that is if you want to be stacking contributions and not doing it balanced throughout the year. But your question around, should I do the pre-tax and the mega backdoor? Again, it's very specific and unique to your situation, which is what I was going to get into next, right? It's a tax planning and it's a cash flow planning component that is ultimately, a lot of times that decision gets driven off of, what do you want to do next and when do you want to do it, right? Because if the idea is just to max out your pre-tax and your future, your pre-tax, meaning 401k and IRA, and your future tax-free Roth buckets, and just have as much tax advantage money in retirement as possible, well, then yeah, what you would do is, the best mechanics for that are max out the 24,500 in the traditional 401k, get the company match on top of that. Then put everything else up to 72,000 in the Mega Backdoor Roth. And there are clients of ours that's what we recommend that they do, based on their plan, based on their time frame, and based on the structure of their accounts today. Right? I had 2 clients last week that we met with, and we had set up this mega backdoor at the beginning of the year for that. They're newer clients that came to us at the beginning of this year. The reason why the mega backdoor made sense for them is both of them came to us with sizable taxable brokerage accounts, right? And they're both on sort of the hybrid path, right? They're both on that phased path, right? If they didn't have the sizable taxable accounts, I likely am not recommending that they put all of that in the mega backdoor concept, because I need to give them some flexibility so that I can bridge the gap. In this case, they're likely going to be exiting. The years are a little bit different because these are 2 couples, and in each case, one spouse is a little older than the other. But let's just say they're exiting in their late 40s and early 50s. Okay, let's just say that as a rough rule of thumb. We need to have some money to bridge the gap between, call it 52 and 59 and a half, when they can access their retirement. There actually is some ways to access your retirement funds earlier, by the way, but again, that's a little technical. I have some videos on that if you want to check that out. So that oftentimes is the decision. Usually we're not giving up the tax break today, right? We're usually not maxing out the 401k if you've got the cash flow to do it. The question is, if you've got, let's just say you've got $100,000 that you can save in a given year, just use a nice round. The question becomes, how do you want to, I call it tax diversification. How do you want to tax diversify that $100,000? Let's say 25% of it is going in, and maybe a little bit more if you do the IRA as well. Let's just say somewhere between 25 and 30K is going in pre-tax. Okay, well, what does the other 70 look like? Should it all go to taxable? Should it be all go to, or should it be a combination? And the math around that, the decision around that, depends on A, what's available to you from a plan perspective, and then B, what does your exit strategy look like? How far down the road is it? How much are you going to need to fulfill, et cetera, et cetera. So let me pause there, Brandon. Go ahead.
Yeah, this was you're touching upon something I think really important that I wish I would have done better planning on, sort of in my last year or 2 as a strategic corporate seller, because I was of the mindset, right, kind of trained in old school thinking, just max out your retirement accounts. And, who knows, maybe I'll be glad I did that at 67, but right now at 47, I'm like thinking, wow, maybe I shouldn't have contributed so much, where right now, I think many of you know, I'm trying to write a book, right? Business is deliberately slower right? And so cash flow is generally lower. And, having some things put in a different account that I could be accessing right now for cash flow while I offset, while I build, while I write a book with sort of a path towards asymmetric returns in the next 12, 24 months, right? That would have done me better than having stuff locked up that I would be penalized on if I were to touch it now. And so I think it is really important, like kind of go back to reinforce the planning on kind of what you want to do and how you anticipate that doing. It does go hand in hand with a financial plan because it's not just the traditional stuff, just pay your retirement self first, right? When more and more people have access to retiring from the traditional corporate world more and more, and it's a more desired move from everybody that you read about on social media today, is kind of telling you go build your own thing and do your own thing. You want life independence, but without a proper financial plan, well, it kind of puts you under stress, and then you're just back into a grind that might even be worse than your corporate role, which is, oh my gosh, I got to pay for life, I got to pay for a mortgage, I got kids to put through school. This is more stressful, I can't handle it, I'm just going to go back into corporate life. So having some more than just cash or dry powder, being smart about your investments and when you're going to want to access those things, it's not just about the future 15, 20 years from now. You got to think like 1, 2, 3, 5 years from now.
Great points. And I'll add a couple on top of that. The taxable account is the only one. Your 401k, you oftentimes can do this, but again, that's contingent upon you being at the company, and it has some negative impacts if you leave the company. The taxable account you can borrow against as well. Okay. Not enough people, the wealthy people do that all the time. Ask Elon Musk how he bought Twitter.
Yeah.
That's how Elon Musk bought Twitter. Okay. You can leverage your taxable account to borrow off of it, right? And essentially just pay yourself back. You're going to pay a small interest rate to the brokerage house, but it's usually, we help our clients do that all the time. Okay. And I've done it myself. And frankly, I'm going to continue to do it myself to invest in opportunities. And when you do that, what happens is you're not taking cash out of the market. So
Yep.
the money's staying invested and there's no negative tax consequences.
Yep.
Okay. So the reason why the taxable account has such great flexibility is A, it's liquid, B, it can be leveraged to loan off of, and C, if you wanted to go invest in a business, that's going to be the number one account that can serve as collateral for you, right? I am a big believer in strategically using debt. I hate seeing clients come to me with bad debt, but strategically using debt, especially as you start to get that business owner framework and mentality, can be super strategic, right? So that's something to also consider as you weigh those decisions around how am I allocating my savings while I'm still in the corporate.
Yep. Good point.
Right? Yeah, you can borrow against rental properties as well. You can borrow against rental properties. The brokerage account is going to be the most flexible, right? It's going to have the most flexibility. I had a client last week that he just left his firm and he had the opportunity to exercise options, and he's really bullish on the firm, right? And he's like, he basically came to me, he's like, I need X amount of dollars. Can you get it for me out of my Schwab account? I said, yeah, but I'm not going to write you a check for that. We're going to borrow against your portfolio. And then when you get your bonus in July, you're going to pay that back. So you're going to pay interest for a very short period of time, but your money's going to stay invested in the market. Okay. And then we added another asset, which in this case was ISOs for him. But that can be done with a business. It could be done with equity. It doesn't matter. Okay. So the last thing that I just want to touch on, then I'll open it up for questions, is the cash flow. I told you dictates the tax strategy now. And then, like I said, the opportunities are endless as you leave corporate, especially if you own your own business. Brandon's probably talked to you a lot about the different things that you can do from a tax perspective there. But the minute you leave corporate, the tax code opens up, right? And you have a lot more flexibility and opportunity there. But you should also be thinking about the cash flow report when you're building your investment portfolio. Way too often, I see, and I do a lot of LinkedIn posts about this. Way too often, I see high earners just investing for growth. Okay. And, that works if you're early in your career. That works if all your money is long term. And that definitely works if you're going to go for the traditional version of retirement, right? Just invest in the index funds, let the market play out over time. That strategy does work. I'm not knocking that whatsoever. But when you get close to needing access to capital, whether it be in your 30s, 40s, 50s, 60s, or 70s, you need to have a portfolio that is built around when you need access to cash, right? So what we talk about is different liquidity bands, right? So oftentimes what we're doing is we're building portfolios for 0 to 2 years, 3 to 5 years, 6 to 10 years, and 10 plus years. And generally speaking, the sooner you need the money, the more conservative it's invested and in more liquid instruments. Okay. So, like, if you need the money in 6 months to 2 years, we're going to keep it in something that's like a high yield. It's going to be better than a savings account, but it's going to be some cash alternative, right? So it's not exposed to a market decline, right? Because if you wanted to, whether it be traditional retirement or go invest in a business, or you just needed to fund and you needed to support your expenses for a period of time, and then the market goes down 30%, well, now you're selling long term money to fund short term obligations. And that is the worst thing that an investor can do, both from a return profile perspective and from a tax perspective. So that's where the cash flow helps us to build out how much do we need each year? How much is coming in? How much is going out? How much do we need? Right. And if you don't need anything for 10 plus years, well, yes, you invest in the growth portfolio. And what our clients are typically investing in with their growth portfolio is heavy equities and then some form of alternatives. I'm a big fan of investing now in alternatives as a piece as well, because something to be aware of is the numbers change by the day, but I think I ran the numbers about a month ago, and 42% of the S&P 500 came from 10 companies, right? So the diversification of your typical index funds is not there to the extent that it was in the past, right? And I'm not saying you shouldn't invest in those. I'm just saying you have to be aware that those 10 companies are a big portion of your overall wealth, that's all that you're investing in. And oh, by the way, those 10 companies are all invested in each other, right? So they're interwoven together as well, right? So those are just some things to consider. So again, I'll go back through the framework really quickly, but it's define what the future looks like, build cash flow scenarios around what you want that to look like. And again, it doesn't need to just be one. It might be, but it might be 10, right? You might model them all out and start to get more confidence around 3, 4, and 5 versus 1, 2, and 3, right? Then build a tax savings plan for today and then a tax income plan for the future, right? And then lastly, build portfolios that are based around when you need access to the cash. I call it life-driven investing. That's the framework that we practice, right? So we're not just investing to beat a benchmark, we're investing for your life. So I'll pause there and answer any and all questions that.
So you had mentioned access to short term. Let's say if you needed to be liquid over the next, say, 18 months, are you talking about money market funds? Are you talking to your treasuries? But like, where would you go? Are there specific accounts that have, 4 or 5+% yields where you're parking money for your clients?
Yeah. We're typically using for the cash component, that short term component. We're using usually a combination of money market funds, short term fixed income. We have actually a pretty nice high yield savings that's got a decent return right now. But it's all stuff that's going to get you somewhere right now in the neighborhood of 4 to 5%. And it's you know nothing is ever completely risk free, but it's generally risk free. That money's going to be there. And oh, by the way, we can access it within a day,
Mhm.
right? We don't need to go exit out of positions. There might be some stuff in there from a fixed income perspective that we say, hey, 25% of it, we might need 3 to 5 days to get out of. But generally speaking, it's very accessible. Yeah. And then you go up the spectrum and you're introducing more equities. And then the furthest end of the spectrum, you're often introducing alternatives. Alternatives come with a different risk profile, added diversification, but usually super low on the liquidity front, right? So that is almost always for 6+ year money.
Can you give some examples of alternatives?
Yep. Again, stuff that, a lot of times wasn't available to the average investor a while ago. We have a couple PE funds that we have direct access to that not necessarily the general public does, but there's private equity funds on most of the Fidelity and Schwab platforms of the world. There's real estate funds. I usually like a combination of private equity, private credit, infrastructure, real estate, and we call them hedge strategies, right? A combination of those, and you can access all of those today in some form of brokerage house, is usually going to get you a nice, slightly higher return with lower risk if you bundle it with a traditional equity portfolio. So what we typically say is your 6+ year money, somewhere in the neighborhood of 20 to 30% should be in alternatives. Not any of the 5 or less year money, but the 6+ year money should have about a 20 to 30% sleeve of alternatives. And that combined with the public markets will create a better risk return profile over time. This fund that we invest in, it had a positive return in Q1 when the S&P was getting hammered. Now you don't get returns daily. I haven't gotten the returns so far for Q2 yet. It's going to trail the S&P in Q2 though. But the idea is it's not correlated. It's not going to zig when the market zigs. It's not going to zag when it zags. So we want to get some stuff that has added diversification there.
Yeah. A lot of folks here, right, are in the corporate role, and some, we heard from Mike earlier, like big tax bills, right? From big high performance years. I see a lot of good sellers over, I don't want to call it overpaying on taxes, right? Because it's kind of a set it and forget it mindset. But like, what are some smart moves, especially like we're mid year, right? And if you're already kind of gearing up or you're expecting a strong second half of the year, like, how do you reduce maybe a few points off of your tax burden so that you can keep a little bit more money in your pocket? The adage, it's not about what you earn, it's about what you keep that matters applies here.
Yeah, there's a bunch of stuff on that. I'll give you a couple of quick ones. There's a bunch of content on our site you can check out on that as well. But I would say number one, especially for strategic sellers where you've got lumpy income, right? A couple of things come to mind. Abnormal income years are tax planning opportunities on the high end and on the low end, right? So if you have like a gap in your job and you have a lower income year, there's some things that you can do. You might want to consider Roth conversions in those years, right? That might be something you consider, right? You would never want to do a Roth conversion in your big income years, right? Because it's essentially like the analogy I always give is if you do a conversion in a high income year versus a low income year, it's like you're getting the same product at a discount. Like go get it at the discounted rate versus at the higher rate. But a couple of things that you can do. Number one, make sure you study your withholding so you don't get the surprise tax bills. I always tell folks, especially if you get bonuses or commissions, your withholding on that money is usually defaulted at the company level. It's not going to be at your tax bracket. If you're somewhere in the 35 to 37% bracket range, your bigger checks when they, whether it be a bonus or a commission, is likely in the 22 to 25% range, and it's defaulted that way. So that's a lot of times why people owe a bunch. You don't necessarily want to owe a bunch, right? Because then where are you going to get the money, right? Yes, hopefully you've got some cash in reserve, but if you've got to sell long-term money to pay for that tax bill, that's no bueno. But at the same time, you don't want to target a huge return at the end of the year. Why? Because if the IRS gives you back a bunch of money in April, you just gave them an interest-free loan throughout the year. So we want to study the withholding to try and get it as neutral as possible. And sometimes there are unique circumstances that I would say if you are doing any sort of charitable contributions, some people just randomly donate to charities throughout the year. Think about a donor advised fund. Okay. What a donor advised fund allows you to do is contribute when you want to in money that's going to grow and then give to specific charities in the years that you want to. So, for example, you're going to have a big year in 2026. You could dump a bunch of money and get the tax break on it in 2026. And then you could just go give it to the charity somewhere down the road. And oh, by the way, if it's invested and all of a sudden it has appreciated stock, what happens is you can donate the appreciated stock to the charity. You basically get the tax break without paying the capital gains, and the charity doesn't have to realize the capital gain either. because if they're a recognized nonprofit organization, right? They're a 401c. I do some nonprofit work, so I see that a lot of times in my work there. So those are a couple of things to consider. You also can play with your retirement contributions, right? If you're going to have a big year, you absolutely should max out your traditional 401k and even the traditional IRA, even though it's not a lot that you can contribute in a given year, you might as well take advantage of that. So those are a couple of things that come to mind. Once you get into business ownership, though, the number of strategies you can run are infinite. I don't know if you guys have ever heard of the Augusta rule. That's like the coolest one in the code. I'm a
Yeah.
boss, so I like that one. That's the coolest one in the code. Allows you to like rent your own house out to your business and get a double tax break. It's a whole deal. You can read up on that one. But there's a lot of stuff that's out there. Yeah, donor advised fund. Yeah, Dave, it's a donor advised fund, sometimes referred to just as a DAF, DAF. And most of the brokerages offer them. And a lot of people think you need to have like millions of dollars to have a DAF. You don't. I think like we use Schwab to custody our client assets, and I'm setting one up now for a client. I think the minimum is like 3 grand, 5 grand, something like that. So you can invest in those strategically, and essentially the money just stays in your account and you get the tax break on it and you gift it to the charity at the time and of the organization you're choosing. Yes, you're right, Ahanya. That's correct. It's the year that the money goes in. That's the key, right? And if you have appreciated stock, you could donate that as well, right? If you have appreciated stock in a taxable brokerage account, you could donate that as well. So, for example, instead of coming out of your bank account and putting cash into the DAF, you could say, "Hey, I've got appreciated stock. I'm going to get the tax break for putting it in the DAF, right? And that's just going to lower my taxable income."
Cool. I know we're at the top of the hour, but I did want to ask you and continue to open up to the floor for anybody who can stay over. Like, for somebody like myself, I love getting into the weeds and manage my money. I know that's not for everyone. When, like, from your perspective, when do you see is like the right time to like do it yourself or work with an advisor like your company?
Yeah. There's no like one size fits all, but like, listen, guys, this is no sales pitch here. It's going to vary depending on your situation. But I think generally the time, the assets that you have, the income that you have, the complexity that you have are all factors. But from a time frame perspective, I typically see folks reaching out to us, and I think it makes a lot of sense when you have that like transition time frame in mind, right? Whether it be traditional retirement, and listen, not that we couldn't do that, but we're usually more focused on the people that want this, phased transition approach. When you have that in your mind, the financial plan is going to be a really, really big value add. And not that you couldn't build it yourself, it's just trickier to build it in Excel versus being able to use the software that we get access to that the general public doesn't. But there's some good software out there. I wrote it down before I came out because I wanted to be able to share it. The one that I like that's available to the general public is called Projection Lab. I like Projection Lab. That one's available to the general public, but our software you can only get through certified financial planners. So typically, when you've got that time frame in your mind, that's when I would at least consider. And by the way, there's a lot of ways that you can engage with an advisor. Like our business model is, we do a very inexpensive financial plan for anybody that we engage with. We get a chance to see if it makes sense for us to work together. And then we have an ongoing business model. And that doesn't make sense for everybody. And the complexity, the assets, what they've got going on. And then, oh, by the way, are you more wired to be a DIYer, or are you more wired to want to outsource? That's another thing to very much consider, right? For folks that have some control over their income and in the future, their time, especially once you become a business owner, but I would even argue as a strategic seller, your time is your most valuable asset, right? So I believe in paying people. I pay people to do everything in my life, right? Literally, I want to work, be with my family, and be with my friends. Like that's what I want to do. And then I pay people to do everything else. I'm a fan of the book, Dan Martell, Buy Back Your Time. I'm a huge fan of that book. But not everybody's wired that way. Some people are just wired to be DIYers. I would then, if you are a DIYer, but you get to the point where you're ready to make that transition, get a professional financial plan. You don't have to pay a lot to do it. And then you decide and you get a chance to see the value of, does it make sense to work with that person or someone else over time? Or is it just a one-time engagement that helps me to visualize what that transition looks like, what my cash flow report looks like, what my tax plan should be, and how my portfolio should be built for the foreseeable?
Awesome. I appreciate that, Dan. And as you know, I owe you some material to go through our own my own financial analysis with you. So I'm a little delayed on that with you. So I am working with Dan to do that analysis. I'm looking forward to it. I am more of a DIYer. I'm just kind of wired that way, and I just have a passion for markets and portfolio management and stuff. But there's other areas of my life that I have no interest in, that I'm amazed that people like to do it themselves. And I'm like, I'm happy to pay other people for that. But I definitely encourage you to, at the very least, you know, go through lessons, all the lessons in Learning Path 5, all built from the perspective of a high earning, high achieving seller. And then when you want to go above and beyond and bounce some ideas from a true expert as it relates to tax and just financial advice that is beyond my pay grade, that's where I recommend working with Dan and his team. Start with the analysis and then, you know, see where it goes from there.
Brandon, one thing I forgot to mention, we just started working with a new tax tool that I want to offer to all of you. I haven't even given this to my clients yet, so it's fresh out the box. But this tax tool allows us to, as long as you have to obviously accept it, but we do government ID verification and we're able to get access to your IRS data. And then what we'll do is we'll do a free tax strategies report for you based on your data. So instead of just the concepts that I mentioned here, we'll give you some stuff that's specific to you. We'll do that for you for free to the extent that it's valuable. And so what I'm putting in the chat now is that's a link to book time with me if you'd like that, or you just want to bounce some of these ideas or concepts off of me. Feel free to use that link to book time. Or if you just have a couple of quick questions and you want to reach out, like I said, I put my my LinkedIn profile in the chat earlier. Feel free to just DM.